This book taught me the laws of trading. I just finished rereading it, and it's one of the best books for trading I've ever read. In this video, I'm going to go over 6 laws from the book that every trader needs to understand. Now, before we jump in, let's go over the author of this book. Is he credible? What sort of experience does he actually have? And well, his name is Augustin LeBron. And in case you're not familiar with him, here's a very quick refresher. He's a former trader at Jane Street, one of the most respected quantitative trading firms in the world, managing over 500 billion. He grew up in Canada after graduating, and initially he started his career as an engineer designing radio chips. But in 2008, he switched over to finance and became a trader, a researcher, and overall a quant. Over his career, he's traded many different types of securities, and he's also created many successful trading strategies while at Jane Street. Now, before I read this book, I've always wondered what separates consistently profitable traders from everyone else that's losing money. And what are the core principles in trading that lead to success? Well, to answer that, at the very beginning of this book, he goes over why he called them laws. Primarily, he calls them laws to try and organize trading principles into memorable laws that become accessible in your daily decision making. The goal here is that thinking about these laws and internalizing their lessons will help you make better trading decisions in all aspects of your trading. As ultimately, one decision in trading can completely blow you up, and one decision that leads you to maybe find a new edge could dramatically change your outcome. So here are the 6 laws that will change how you make trading decisions for the better. And I can speak just from my personal experience, it has tremendously helped my trading, and that's why I've read this book a couple of times. Now, number 1 is the law of motivation. Know why you're trading. Self-awareness is key in this. Many trade for the wrong reasons, like boredom or thrill, and I've definitely done that when I was starting out in my first year. You want to examine your true motivations and align them with sound principles. Your why really does shape everything. In the book, he goes over different types of motivations and how they can affect your trading, and also he gives some examples in real life and also in trading. And also one thing I think is really important to understand is trading, in a sense, is a competition game, right? You're trying to beat another person or, trying to beat the market, right? And you need to be aware of your own weak spots. Then you can more easily navigate these dangerous waters, and also you can't get targeted as easily. So you want to know why you're trading in the first place or why you're even taking on this certain trade. Now, the next part is take only risks that you're paid for, hedge the rest. Every trade has multiple risks. You want to identify your edge, or if you're being paid for that risk, and isolate it. Unexpected risks can completely overwhelm your profits, so you want to be sure to use tools like options or futures or whatever market you're trading in some way to neutralize the unwanted exposures that you have. Overall, this is just a key mechanism of risk management, and in the book he does a great job of defining what is risk, how there are different types of risks, and then how you can somewhat navigate to deal with these risks. Obviously, it's going to be more dependent on what particular market or instrument that you're trading. But the goal here is that you only should have exposure to the risk that you're willing to take or you're getting paid for ultimately with it. Also, one kind of technical thing I really liked from the book is how he goes over that you can't just look at one specific view of risk. For example, like just looking at standard deviation, max drawdown, etc. Those all are technical risk measures, and they can be super useful, but there are ones that you won't know about or that you can't really calculate for. The next is if you can't explain your edge in 5 minutes, you don't have one. Your edge comes from understanding something about the market that the marginal trader doesn't understand, or being able to act on something they can't. It's not about being the best trader. It's normally about being better than the median share trader. And this is one thing to actually think about. Remember, bad traders don't actually last that long. So your competition normally is everyone that survived. Now, obviously, there's a constant inflow, right, of new bad traders or new traders that are coming into the game that you'll have more experience over. But it is also a natural mechanism of why markets start as, let's say, more inefficient, especially when they're a newer market. And as time goes on, it becomes more efficient because new players that have been experienced in other markets come into that market. Those players that have been in that market and been taken advantage of, then, they can basically develop, and you'll get only the people that have survived and learned from that. I also like the way he put it, of that the long-term profitability of an edge is inversely proportional to how long it takes you to explain it. Meaning that if it's a really complex edge, let's say it's a very high frequency arbitrage on a particular 2 exchanges, or anything that's very complex like that. Maybe you're using multiple machine learning models to calculate a fair value price, all this sort of stuff. It's somewhat inversely proportional to how long that's going to be profitable, because often those sort of things that are very difficult to explain, they may have a very high Sharpe ratio, for example, so they're really profitable, but they're often not going to last very long. Whereas something that's really easy to explain, for example, you were taking on a certain type of risk, let's say volatility risk or something like that, very easy to explain. Those will often last longer, but they often won't have actually the highest amount of profitability. Think of it sort of as the difference between an inefficiency and a risk premium. I actually have a video about those two differences on this channel. I've actually probably spoken about it way too much, but you can check out those other videos as well. Here's a great part in the book about understanding and acting. And this is around primarily that all trades that have edge are profitable because there is some fact about the world that you understand and can act on, and the marginal participant doesn't understand or can't act on it. Thus, describing your edge is explaining what you know and can do, which others do not and cannot. He gives an example around a business and like about a person that's importing kind of frozen tuna and like he has an advantage of it. I think a great thing through this book, especially if you're a newer trader, he gives a lot of real life examples to where you can understand it in a practical sense. So it doesn't have to be super technical, and you may not fully get it straight away, but he always does give an example in traditional, world example, like a business or something like that, right? Where you can understand it really clearly, and then it maybe takes you just a bit of time to link that into trading. Now, 4 is the impossible can happen. Be prepared for unprecedented events and maintain your humility. Stress test your strategies against extreme scenarios such as the 2008 financial crash or even 2020. And remember, enough people relying on something being true can make it false. And I think this is really true with the latest kind of flash crash in crypto. That was the biggest liquidation event ever. We actually just did a podcast about it. It was $20 billion in a single night. And a lot of people weren't expecting that to ever happen, right? And that's also a prerequisite of a flash crash. No one's really expecting it. No one sees it coming. And then boom, everything happens. And it would be quite, ignorant for you to say that's the last flash crash that's going to happen, or that's the last big liquidation. There's always going to be new, bigger events. You never know if it's going to be next year or in 5 years or in 10 years or 20 years, but there will often be another one. He gives an example from Alice in Wonderland, how it's like 6 impossible things before breakfast, and how you can look at the world of believing impossible things can actually happen, and what does it kind of feel like to do so. And in trading, this is really true. Like your max drawdown, for example, that you see historically gives you a very good expectation, but it is not the max drawdown you will ever experience depending on how long you run that strategy. Most of the time you will have a bigger drawdown in the future, and you will have to be prepared for it. So just because something is low probability or has never happened before, don't expect it to never happen. Now, number 5 is data skills are non-negotiable. In his view, success hinges on extracting insights from the sea of data. You must be able to have access to and analyze data sets and leverage technology to gain an edge. Embrace the role of tech and data capabilities to strive to stay ahead. Now, while personally I agree, because obviously I'm an algorithmic trader, I deploy strategies in futures markets and also crypto markets, and I've been trading for the past 6 years now, and data and coding is a huge factor of my own trading personality, or my own trading journey, let's say. But I do know a lot of discretionary traders that don't use that much data, and they still do very well. So I'm not going to say it's for everyone a non-negotiable, but I will say if you're trying to be a systematic trader, which you probably are if you're watching this channel, data is one of those cool things where you need access to data, and you need to be able to understand how to analyze that data and also look through it. He goes over the value of data and the value of technology, and a lot of times, like some of the biggest edges come from new technology, which I think is very true for a big part of things. So being able to have either access to a developer or your own skills to maybe be able to automate some of your trading can be a huge factor of increasing success, and also maybe even increasing profitability over the long term. If you do want to automate your strategy, I'll leave a link in the description where I can help you code and develop your current strategies into algos. Now, the next part is keeping an eye on your costs. Now, I already know some people are probably going to say this is kind of boring. What a boring ass lore to just keep an eye on your costs. But markets are fiercely competitive. Huge edges often don't last very long, and costs such as visible ones, fees and spreads, and then invisible ones such as market impacts, trade decay, etc. A lot of the time people really underestimate their costs and overestimate their edge. Especially I see this when people are backtesting, let's say 1-minute strategies, 1-minute bar strategies, and not accounting for cost at all. When you're running a strategy on that low of a time frame, you're going to have very high rebalancing and turnover, which means you're going to have very high costs, both in fees and in spreads and slippage. So if you don't include those costs, you're automatically going to be looking at strategies that just won't be working as well as they would in the live markets. So you need to be able to account for those and understand those and how that impacts overall trading strategies. Another part of this is also including opportunity costs. I think this one's a very difficult one to really measure for in like a true aspect. But there is obviously an opportunity cost for having capital in one strategy and not in another one, or a sudden amount of allocation in one place and not in another place. So you do have to try and think about that and see how that could affect your portfolio. He has a great kind of category going over different types of costs, obviously the visibility ones and the non-visible ones, so you can understand that from a foundational level. Now, there are many other great lessons in this book, and it's why it's a book I often refer to and also like go through. I don't read the whole thing every single time, but I often go through each chapter when I'm thinking about a certain topic, because a lot of this book gives you the foundations of how you should think as a trader and also the aspects you need to understand as a trader. And it's probably one of the best books I've ever seen to do it, in my opinion, especially if you're wanting to be more systematic, maybe if you want to be algorithmic. But I will say this also somewhat applies to discretionary traders as well. I would much prefer handing this book to someone in the early stages of their trading career rather than trading in the zone or something like that. This is going to give you a lot more practical knowledge in the sense of that you will understand how you could apply it once you start trading and once you start, over the years of your trading career. There will also be things you may not understand straight away, but 2 years later, you will understand a lot better because of your experiences in the markets. And that's it.